Okay, let's dive right into this explainer. Today, we're unpacking a truly fascinating scenario: why one cryptocurrency investor actually celebrated a losing month. I mean, in the high-stakes, hyper-fast world of crypto, we're constantly bombarded with wild stories, right? Massive overnight gains or catastrophic portfolio-wiping losses. But the day-to-day reality of long-term investing? Well, it often looks a whole lot different. We're going to look closely at a real-world case study from July 2026 to see exactly how a strictly disciplined approach can completely change the way you view a dip in your portfolio.
To set the stage here, during the post-crash uncertainty of July 2026, an investor, documenting their journey under the name TheAbrahamCryptoLand, saw their total unrealized loss across all their cryptos sit at around 2.8%. Now, seeing a negative number on your screen is never, an exciting experience. Human nature totally conditions us to want to see those green upward arrows every single time we check our accounts. But here's the kicker. For this specific investor, this 2.8% loss was considered a massive strategic victory. So how on earth could a loss actually be a win?
Well, that brilliantly illustrates our core theme today. As the source material puts it, sometimes the biggest decision is having the discipline to do nothing. It's so true. Surviving the crypto market isn't always about actively trading every single peak and valley. Often, it's really about holding your ground, sticking to your predetermined rules, and just resisting that huge urge to tinker when emotions are running high. Section 1. The July 2026 Crypto Market. To understand why doing absolutely nothing was such a powerful move, we have to look at the broader market conditions right after the big June decline. Notice how Bitcoin, which, let's face it, pretty much dictates the whole market, basically just moved sideways during this time. It was a market desperately searching for a bottom. You have the price bouncing from a low of around $57,000 early on to a high of roughly $66,700 near the end of the month. It was essentially a recovery period, completely lacking any sort of major breakout or strong upward momentum. Honestly, compared to the usual wild chaos we see in crypto, a flat sideways market like this is almost painfully boring.
By the time the month wrapped up, Bitcoin had only recovered by about 5.4%. And because of this incredibly stagnant, sideways movement, prices just never hit the investor's predefined buying or profit-taking levels. The other cryptos in the portfolio, they followed a very similar, totally uninspiring pattern. There were simply no major opportunities presenting themselves that fit the established strategy.
Which brings us to Section 2, Inside the Portfolio Strategy.
So how exactly does a system handle a total lack of obvious opportunity? Well, a strict, thoughtfully diversified blueprint is the answer. This strategy for the 2026 to 2027 period wasn't just thrown together in a panic during the July dip. No, this blueprint was designed long before the market fear even started. The overarching goal here isn't to play psychic and predict every market ripple. It's to create a robust, reliable system that guides better decisions over the long haul.
Breaking that blueprint down, we're looking at a portfolio heavily weighted toward the major players. You've got Bitcoin commanding 40% and Ethereum taking 20%. The rest is meticulously divided up among XRP, Bitcoin Cash, and a handful of very specific altcoins. But here's what makes this truly fascinating. There's a built-in safety rule. If any crypto in the portfolio essentially goes to zero or fails, its allocation percentage gets strictly reassigned right back to Bitcoin for the rest of the period. By cementing this diversification and actually planning for failure, the investor effectively built a fortress against volatility.
That means every single move the investor makes is governed by 4 core pillars: predefined levels, strict portfolio allocation, rigorous risk management, and long-term thinking. This framework is explicitly designed to strip short-term hype, wild predictions, and emotional reactions completely out of the equation. It forces you to look right past the noise of the day-to-day market chatter.
And that strict, unwavering adherence to the rules, that is exactly why a remarkably low 4 total transactions were made throughout the entire month of July 2026. Just 4. The goal wasn't to trade every tiny little bump in the market. The goal was to protect capital and only execute planned decisions. It's simple. If the predefined levels aren't hit, the transactions simply do not happen.
Section 3. The Power of Doing Nothing. The real battle here wasn't actually against price movements at all. It was against human emotion. During July, the investor openly admitted to feeling the urge to buy more crypto, not because the strategy said to, mind you, but because of good old FOMO, the fear of missing out, or just this gut feeling that prices looked attractive. An emotional investor frantically changes their strategy on a whim. They buy when everyone's hyped up and they panic sell when the fear sets in. But a disciplined investor, They rely entirely on those predefined levels and systems we just talked about. They control themselves, even when the emotions are screaming at them to do something.
Section 4. Surviving the market cycle. Look, every market cycle includes periods of intense uncertainty. But a boring, beautiful, flat performance curve, that is the reality of risk management in action. Ultimately, being a successful investor doesn't mean you win every single trade. It means you survive the brutal periods by rigorously following your plan. That incredibly flat line, representing that minor 2.8% unrealized loss during a really shaky month, is pure visual validation of discipline. It proves, without a doubt, that the system held up exactly as it was designed to under pressure.
So the critical takeaway from this entire case study really comes down to perspective. The important question to ask during a market downturn is absolutely not, did the price go down? Prices are always going to fluctuate. That's just a fact. So the next time your portfolio takes a dip and you feel that sudden heavy urge to panic or just abandon your strategy altogether, stop. Stop and ask yourself this one vital question. Did the reason behind my investment change? If the answer is no, then perhaps your absolute best move is exactly what we saw today, having the iron discipline to do nothing at all.